Good afternoon, everyone, and welcome to this IIEA seminar on the economic outlook. So something has come up for Dan O'Brien at short notice, so he asked me to step in and chair the seminar, which I'm delighted to do. My name is Ray Lydon. I'm an economist in the Monetary Policy Division of the Central Bank of Ireland. My main role in that is briefing the governor, so Gabriel Makhlouf, in advance of governing council meetings where the 21 governors and the 6 ECB executive board members meet roughly every 6 weeks to set monetary policy. The next governing council meeting is actually coming up in early February, so the timing of the seminar is excellent from my perspective. But my presence here is very much personal capacity, so I'm not representing the Central Bank of Ireland or the European system of central banks. So as everyone will know, the global outlook is complicated by geopolitical tensions, shifting trade policy, rapid evolution of AI, question marks about the labor market, to name a few things. So we've got really 3 excellent speakers here today to talk us through some of those things. So Alan, if you don't mind, I'm going to start with you. So Alan Barrett is a research professor at the Economic and Social Research Institute. So Alan previously served as the CEO of the ESRI between 2015 and 25, has had several academic roles and is well known for lots of his research. So really delighted to have you here today, Alan. I think in terms of the outlook for the Irish economy, the recent ESRI projections kind of give a mixed picture. So continued growth, but moderation from the kind of strong growth we saw in earlier years with some notable headwinds. So do you want to kind of talk us through some of that narrative and maybe some of the key headwinds you see?
Yeah, sure. Thanks, Ray, and again, thanks to the Institute for the invitation to chat to people today. Yeah, I thought I'd sort of just begin with a little description about how we went about sort of formulating the most recent set of forecasts. And I think as anybody on the call will know, when it comes to forecasting, I mean, one of the approaches we always take to this is the following. I mean, we have a sort of a sense of what a sort of a normal growth rate would be, if there is such a thing. But we normally expect the economy, or again, normal economies, to grow maybe about 2.5% to 3% a year, that sort of a range. And so very, very often in forecasting, what you're doing is you're asking the question, well, is the sort of the current rate of economic growth higher than normal, or is it lower? And if it's higher, you're expecting things to sort of converge towards normality, and there's a downward direction. And if things are below, then you're expecting the economy to move towards in an upwards direction towards that normal rate. So really, since the pandemic, I mean, the Irish economy has enjoyed high rates of growth, and I mean high rates of growth in the sense that being generally in excess of that sort of 2.5% to 3% level. And I'm not going to get into the details of what precise metric here, but again, I think everybody in the call will be familiar with the general metrics. So, I mean, just taking the data from 2025, there's clearly, again, a sort of a strong degree of buoyancy in the economy. The standard things we look at, employment has still been growing strongly. The tax revenues have been performing very, very well. So lots of buoyancy, and it means then that we will register, when we get the final details, we'll register a strong economic growth rate for 2025, possibly in the sort of the 3.5 region. But as you said there, Ray, the thing we're noticing in the latter part of the year is that growth rate has started to moderate. Okay, so exactly the sort of thought experiment we do as forecasters, where you're looking at a high growth rate and you expect things to moderate a little bit. For once, maybe the Irish economy is actually performing as we might have expected. And one area where that moderation seemed to be manifesting itself is in the labour market. So if you go to the earlier part of the year, or even the midpoint of the year, employment was growing something in the order of about 2% a year. The most recent data towards I think in the third quarter is now showing that employment is growing by about 1% a year. So quite a significant moderation, actually. And with employment only growing at that level, it means that the unemployment rate is now being sort of ticking up a little bit. So we got used to seeing unemployment rates at the sort of below 5%, and now it's sort of just nudging up in that direction. So in doing the forecast, we've sort of applied that standard sort of methodology, assumed that sort of moderation will continue into 2026, but as I said, from a reasonably strong level. And that means then that we're expecting growth in the economy. If you take modified domestic demand, we're looking at 2.1% for 2026, underpinned by, again, employment growth in the order of about 1%. So all sort of, it's pretty good at the headline level. But of course, the trick in doing forecasts is also to sort of say, well, like, what are the possible things that might knock that central trajectory? Of course, these can be positive and these can be negative. But in the current context, it's obviously very, very hard to see the positives, and it's much more predictable in a sense that we'd start worrying a little bit about the negatives. Now, I had a conversation with somebody recently. They basically accused me of being sort of part of that generation of Irish economists that were so scarred by the Great Recession that we spend our time looking for the next collapse or whatever like that. And maybe there's an element of truth in that. But having said that, I mean, I think the risks are very, very clear. Daniel might talk a little bit more about some of these, so I won't go into great detail about them. But I mean, some of the risks, obviously, there's the geopolitical risk, and as I said, we can flesh that out in the discussion a little bit more. There is the international policy risks as well. I mean, the most recent in the last few days has been the Trump potential prosecution of the chair of the Federal Reserve. Again, a pretty extraordinary development, and the implications could be acute. It's hard to know if we're finished with tariffs or not. I think we got somewhat comforted over the course of last year about where tariffs were going. But as I don't think we can relax entirely on that. And then, I mean, again, some financial risks which seem to be, potentially there as well. I mean, again, people are talking about things like a possible AI bubble. I mean, that's in two areas. I mean, firstly, there's remarkable expenditures going into AI and these investments, and these seem to be, again, one of the reasons behind a relatively strong growth performance in the US economy. But worried now about the tech stocks. So sometimes when there's reference to an AI bubble, some of this is related to the potential drop in the value of the tech stocks, but it does seem to be linked as well to perhaps a sort of an overestimation of what the impact of AI is ultimately going to be. And again, we have to sort of see how these sort of things are going to work themselves out. So just to conclude with a couple of sort of domestic policy notes. So we have the sort of the economy doing reasonably well, and we've reasonable expectations about how it might continue doing. We obviously see these risks, and then it always comes back to this idea, well, what are we doing nationally to make sure we're as insulated as possible? And on this again, I mean, this is the point that your colleagues, Ray, the central bank have made, and IFAC and others. In the context of risks, you want to see a policy sort of mitigating those risks to the greatest possible extent. But this ongoing increase in expenditure on the back of the windfall corporation tax really seems to be going in the opposite direction to the sort of risk mitigation exercises that you'd hope to see. So obviously, it's a long time before the budget happens, as in October. That'll be the budget for 2027. But nevertheless, it'll be interesting to keep an eye over the year as to what actually happens to expenditure, and does it drift in the same way that it has in recent years. I think a lot of us have a sense now, with sort of the budget constraint almost removed because of the strong corporation taxes, that there is just essentially a real lack of fiscal discipline. Other issues that I just want to throw into the mix, possibly for further discussion. I've mentioned risk mitigation in the sense of, from a fiscal policy perspective. The Mercosur discussion recently, I think, again, has been quite surprising. If we really believe we need to be diversifying our trade relationships and everything like that, again, standard risk mitigation type effort, the Mercosur debate was just very, very hard to understand. And last thing I'll say then, in terms of the needs for 2026, I know Michelle will talk a great length about housing, so I won't. But it will be interesting to see this year if the sort of the recommendations of the infrastructure task force are going to be put in place, and if we're genuinely going to see a sort of an acceleration in infrastructural investment. But I'll leave it there now for now, Ray.
Thanks, Alan. It's all very interesting, and I think I'd agree with everything there. I'm glad to hear you brought up Mercosur because that was one of my questions. Just on the labor market, because that's what I do. It seems to me we're in a kind of low hiring, no firing sort of dynamic at the moment, and I think this is consistent with your employment growth slowing. Do you see, AI playing a role there in the low hiring environment, or is it too early to tell? Hard to tell.
It's probably hard to tell. It does seem to be having an initial effect. But I mean, as to how strong it actually is,
Yeah.
I think we'll have to wait and see. And of course, there's the sort of there's the two dimensions to it. There's the, let's call it, it's almost like a positive AI effect, which is in the sense of I mean, positive, okay, displacing workers, but hopefully, we can find new roles for those workers, and you have that sort of creative destruction. I think the thing we've begun to worry about is, again, related more to the AI bubble. If there is a sort of, it's not so much that AI is going to have an effect, it's the the potential recognition that AI might be overestimated at the moment in
Yeah.
terms of what it's actually do, and so that you would have that sort of an adjustment. But again, across the labor market, I mean, there's the AI issue from one perspective, but there are also those sort of the labor cost type issues too that IBEC, for example, have been talking about. Now, where truth lies in this, I don't really know. But between sort of increases in the minimum wage, the auto enrollment, situation, it does seem, that there have been, and for very good reasons. I mean, there have been increases in the cost of labor at various stages, and maybe it's the combination that at various points you could have those sort of increases, and employers just absorb it. But in the context of sort of heightened uncertainty and stuff like that,
Yeah.
then maybe there is a sense that they're having an impact as well.
Yeah, I think I broadly agree with that take on it. Thanks, Alan. So I'll move over now to Daniel. So Daniel Kral is a lead economist in the macro forecasting team at Oxford Economics. I think, Daniel, I was looking at your bio. You cover the Nordic region, but you do a lot of thematic research in the Eurozone as well. So really interested to hear your views. When I look at your recent projections, the narrative looks very like the ECB's projections in December. So steady but not spectacular growth in 26. Consumer spending, resilient labor markets, all key factors. But then this divergence in the fiscal outlook. So some countries expansive, some countries not in a position to expand fiscally. So maybe talk about a few of those things, and what's your take on Europe, Euro area, or even the global economy?
Cool. Thanks for the invite here. So I would position Europe more globally. At OE, we are below consensus slightly on Eurozone growth. We're at 1%. The consensus is around 1.2, same as the ECB. We are significantly above consensus for the US. We are actually the top of the range on the US. And I was just reading the latest note from our US team, and they've further upgraded their growth forecast for the US. And on China, we're also slightly above consensus. So you have this sort of the two big blocks that are, you could say, are squeezing Europe, US and China outperforming, and Europe in the middle, kind of struggling more. And as you mentioned, there are the growth drivers is nothing really new. We've got this sort of real income growth or declining interest rates, easing financial conditions that should drive a sort of a cyclical pickup, even though the quarterly growth rates should be sort of nothing to shout home about. On the fiscal side, that's a very interesting point. I know people at the ECB have this notion, and many of them, that the fiscal will loosen this year. That's built on rather optimistic assumptions about the scale and speed at which the Germans can deploy their fiscal stimulus. So far, what we've seen, as is always the case in Germany, things tend to move rather slowly. So it is coming. There is a big German fiscal bazooka coming, but it's really going to be felt more from the latter half of this year and into 27. That's why if you take that out, if our assumptions about the German fiscal stimulus this year, together with fiscal contractions in other countries like France and some of the southern economies like Spain and Italy, you will see that on net it's largely neutral. So we don't really see this as sort of providing an upward lift to inflation, which is what some of the hawks are about, that fiscal policy is going to be fueling inflation this year. So really, it's kind of a muddling along kind of outlook at the Eurozone level. The risks that you mentioned apply especially to Europe on the trade front. We're more open to trade than the US or China, and we are being squeezed by both in different ways.
And just, in my own area, the ECB projections have this kind of small undershoot in inflation over the next 2 years, but it's seen as quite a temporary phenomenon. Is that something that you've dug into much?
Yeah, so if you look at the components, you've got the volatile bits like energy and food, and those are the ones that are meant to drive this undershoot. The ECB will look past that typically. They'll look at more at core inflation, which is a better predictor of longer term where inflation will land. And core inflation is sort of still above 2% in the Eurozone. It's expected to moderate, but again, it doesn't signal, at least in the near term, that the ECB should be easing policy. And so I think our outlook is for a flat rates profile from the ECB for this year and into next. Again, you could talk about the risk distribution, given that we're below consensus on growth and the sort of the squeeze that we're getting from China and from the US. You could argue that the risk to activity from the external sector are to the downside, which could lead to inflation undershoot where the ECB is sort of forced to stimulate the activity. But we're not there yet. From the recent communication, the ECB is very happy where it is. Headline inflation is bang on target, 2% in December. If you look at all of 2025, it's been hovering above around 2%. So even though you have these wild differences in components, energy being deflationary, core inflation is still stuck quite stubbornly above 2%. But the ECB ultimately targets headline inflation, and on that front, they can pat themselves on the back that they've done a good job. And so looking ahead, they are aware of the risks, both to the upside and downside. And so they're still in the wait and see mode rather than preempting and moving based on the sort of their assessment of risk distribution. They're more likely to move based on more backward-looking data as we get the inflation numbers.
Yeah, so the emphasis will be on the quarterly meetings with the projections as opposed to those kind of interim meetings. I think I'd probably share that view. Thanks, Daniel. Over to you, Michelle. So welcome. Sorry, I didn't get to talk to you at the beginning, but it's great to see you again. So Michelle Norris is a professor at the School of Applied Social Science in UCD and a director of the Geary Institute for Public Policy. Many of you will know Michelle's research, particularly in the area of housing policy, and this relates more broadly to economic policy. So very welcome, Michelle. I think we've heard kind of the macro picture for Ireland, Michelle, the macro picture for Europe and globally. And, a lot of the story for Ireland, and Alan touched on it, is about infrastructure deficits that constrain growth. And in Ireland, the big one here, and I think in many countries, is housing. And like I said, you've done a lot of work in the area of housing, been on a number of public boards, talked about the distributional aspects, about inequality, wealth distribution, boom-bust patterns, everything. So do you want to talk us through where you see the housing picture in Ireland in 2026? Might we see some light at the end of the tunnel if the infrastructure plan gets put into place?
So thank you for asking me to participate. I see the housing situation in Ireland as particularly challenging compared to the rest of Europe. So you mentioned that many European countries are experiencing housing deficits, and this has expanded since the global financial crisis. So that's quite a widespread trend in the countries where the population's rising. And we see in particular challenges arising for housing middle-income households. There's a real squeezed middle challenge developing in housing in the stronger economies of Western Europe and Eastern Europe, and the new Affordable Housing Action Plan the EU have recently published really flags that up as an issue. So our challenges are not unusual, but I suppose the scale of our challenge is unusually strong, and the barriers to us surmounting the challenge are unusually strong, and some of the responses the Irish government put in place are unusual. So, I mean, the scale of our population growth has simply been enormous, as I'm sure all your listeners know, in recent years. And the Housing Commission, of which I was a member, did an analysis of the deficit in housing supply and of the scale of housing supply going forward that was needed to cope with population growth. And I mean, just to summarise their analysis in simple terms, they essentially said our housing stock would have to increase by 1/3 by mid-century to address the deficit and provide enough housing for our existing for the scale of population growth they assumed would take place, because we're starting from a very low base. We have among the lowest numbers of dwellings per 1,000 inhabitants in countries of Western Europe, and our population rise is extremely strong. So, I mean, outside a kind of a post-war situation when lots of governments in Europe built lots of houses post-war, and outside, countries like Singapore, which are commonly cited as good examples of a lot of housing output, but they're not full democracies. I'm not aware of a full democracy outside a post-war situation that's managed to deliver the scale of housing we need, assuming population growth rises. So I think sometimes the scale of the challenge is understated. Also, issues are raised, for instance, around vacancy rates and dereliction, and obviously dereliction is a very negative thing, particularly in rural towns where it's undermining the atmosphere of main streets, etc. But we have very, very low vacancy rates in Ireland. It's 1.5% in Dublin. So we should, by all means, address vacancy, but our vacancy rates are well below the so-called natural level of vacancy. There's a concept of natural level of vacancy you'd expect in a housing stock, just like natural level of unemployment. So that isn't really a solution. The only solution really is more construction. We have big challenges associated with meeting that due to the way in which the bust played out in Ireland, and the fact that so many developers went bust. So since the bust, we kind of have developed an oligopoly kind of a situation in construction where there's 5 big developers, and then there's a lot of very small companies. There's very few in the middle, and we probably don't have enough big developers. And traditionally, house building was funded by bank loans. In fact, as we know, during the Celtic Tiger, overfunded. But now the level of mainstream bank lending for construction is still very low. So that raises challenges just about funding the private output. So in response, the Irish government has been really, really activist in terms of financing new social house building. And they also have started to subsidise first-time buyer purchases, and they've developed a new kind of housing policy. Analysts call it kind of an intermediate tenure focused at this squeezed middle called cost rental housing. So all of those developments have been really positive, and because our public spending on social housing was cut so radically after the global financial crisis, we have a huge catch-up challenge to deal with in terms of social housing supply. So I think there needs to be more output. But Ireland is very unusual among Western European countries in that the capital costs of building or buying social housing are almost 100% funded by government. In the vast majority of other countries, government funds a small proportion of the capital cost, often in the form of a grant. Sometimes they give interest subsidies to cope with interest payments. But most of the sector is funded by bank borrowing, bonds, etc. And then those loans are repaid using tenants' rents, and rents are linked to cost. So in most other countries, the sector is outside the government balance sheet, not as exposed to the challenges Alan mentioned we're potentially facing in the public finances, and much more sustainable from a financial point of view in terms of keeping output even. And I suppose a concern I have in Ireland is, even though I definitely support the expansion in social housing delivery, we haven't seen that expansion being accompanied by reform in terms of how we finance it and deliver it. There are kind of organisational challenges in terms of local authorities in particular delivering enough social housing, because they're just small organisations generally delivering in a really challenging delivery context. So the Housing Commission tried to encourage government to look at reforming the financing of the sector. And just one final issue I just wanted to flag briefly: the new housing plan from the government, which is quite similar to the old housing plan. And that's not a bad thing in many ways, but one thing I am concerned is the previous housing plan had financed about 4,000 of these cost rental intermediate rental units, and I view that as absolutely vital, particularly in Dublin, where those types of households that their incomes are too high for social housing but too low to be able to buy are facing huge challenges. And I think they've played a really important role in addressing the needs of that cohort. And but the latest plan doesn't include any cost rental objectives, so that's just one issue I'm concerned about that doesn't seem to have been mentioned in the media. So I'm just concerned that they won't continue to support that type of output.
Thanks, Michelle. I'm kind of reminded of Tolstoy's two great warriors. Time and patience here is really the answer. But the scaling up supply. We have scaled up supply before, like you said there in the mid 2000s. We were putting out 80,000 units a year. Now that was an excess period, credit bubble, all the issues around that. But we were able to import the labor as well from the new CEE countries joining the EU. Where do you see labor shortages here as part of the problem, or is it more about land? Is it more about finance? What's the balance of shortages here around delivering the supply?
I think finance, particularly for private development, is a key problem. Labour is also an issue, and only about 4% of work permits in recent years are for construction workers. So I was personally surprised by that.
Yeah, that is right.
One other challenge is we are trying to simultaneously increase housing supply radically. We have very high standards of new houses in terms of BER rating, etc., etc. They don't exist in the UK, for instance. The UK are currently debating whether to bring in the same standards we have. So we're trying to do that, but we're simultaneously trying to retrofit the housing stock. And we are simultaneously facing this huge challenge around infrastructure delivery, some of which is necessary for housing delivery. I mean, the water infrastructure in Dublin, for instance, is close to capacity and will soon prevent us from delivering more housing. So it's very hard to prioritise all those things simultaneously and to meet those labour needs. And I think we may need to prioritise. And I personally think certainly in terms of retrofitting the existing stock, focusing on what architects call adaptive reuse of existing dwellings, we're converting those over-the-shop units in towns that are currently not being used, unused commercial facilities into housing would be a better use of our labour resources rather than trying to retrofit everything, particularly more modern buildings that have a relatively high BER. So I think doing that and delivering new housing is very challenging. Also, in terms of construction technology, productivity levels in the construction sector are extremely low. And we haven't really embraced the use of modern methods of construction and issues, methods that might reduce our reliance on skilled labour. I mean, house building is still a craft industry, in a way that, my father was a stonemason, and in lots of ways that hasn't changed since he was an apprentice. But and that certainly has helped with developing high density construction elsewhere in Europe, apartment blocks, etc. One challenge we have in Ireland is we have a small market. We have lots of different providers, the different construction industry firms, the social housing sector, etc. So we may not have enough of a bulk purchaser that would be required to kind of force the industry to adopt more modern methods of construction, or just make it economically viable to do it. So the Land Development Agency, which was set up by government after the crash to manage public sector land banks, and of which I'm a former board member, I should mention, they have tried to start prioritising standardised designs for their dwellings, and they have issued a book of potential designs, and versions of these will be used in all dwellings. And if that was used by them and more widely across the social sector, that may make it more viable for industry to set up the factories that would do semi-prefabricated construction of new developments, for instance. So we need to start thinking about those other things, the kind of strategic management of all the elements of this sector and of supply.
Yeah, I think I'd strongly agree with your answer to that one. So that's a good note to end on. And let me just say thanks to Michelle, Daniel, and Alan for excellent content, and really appreciate you coming here today. And thanks to everyone for attending, and see you soon. Thank you.
Okay.